Hey, welcome everybody. Welcome to today's webinar on the Great Sunset. We'll be talking about the Tax Cuts and Jobs Act sunsetting provisions. What we're going to help you with is identifying some areas that will help you reduce taxes, not just into the next year, but over your lifetime. I'm today's host, Conrad Levesque. I am a CFP or a certified financial planner. I'm also a CPA and I'm bucket plan certified. I'm a lead wealth and tax advisor at Alison Wealth Management. I've been in the industry over 20 years, and I know probably more than anybody wants to know about tax law, as well as financial planning. We're going to talk today, and I'm going to preface this with, we are not here to be political, right? We all know that we're in the midst of an election, and to avoid any negative connotation, we're not going to talk about any one political party. We're simply going to talk about facts as it relates to what is the likely scenario that is occurring. We all know that one president or the other may propose a plan, and we've actually gotten some insight into those. However, it's not the president that gets their way typically. It does require approval from Congress. And so what we're going to talk about today is really just the facts of what we expect to happen because of Congress and some of their inability or problems getting things done here in the recent years. So we got here in 2017 when then President Donald Trump passed the Tax Cuts and Jobs Act. Right, this was the biggest major legislative change to the tax code since 1986. And you might say, well, how was that done? He didn't get all of the votes or the majority of votes in Congress, and that was passed. You'd be right. That was passed under what's called the Byrd Rule. Now, the Byrd Rule is part of a budget reconciliation process that simply means the Senate only has to have simple majority in order to pass provisions in the law. However, that is coupled with an automatic sunsetting of these provisions up to 10 years. And in this case, the provisions that were passed in 2017 expire at the end of next year or 2025, so even less than 10 years. Now, whether you agree or disagree with the provisions that were in the law, the fact is we are facing a large deficit at the governmental level and the national level. As you can see, we have what could be described as a doomsday clock ticking up on the top left of the screen. And so when we're looking at whether taxes will likely increase or decrease, we do know with those sunsetting provisions that we will likely see an increase across the board of each individual level. And ultimately, the likelihood that taxes are lower into the future as a result of what you see on our screen, which is that U.S. national debt continuing to climb, is pretty low. So with me today, I have my colleague, Dave Allison. Dave is also a certified financial planner. He's an enrolled agent admitted to operate in front of the IRS. He's also bucket plan certified, but he's the CEO and founder of Alison Wealth Management, which is a holistic wealth management firm with offices in Palo Alto, California, Mount Pleasant, South Carolina, and Marietta, Georgia. He's also the president and founding partner of Prosperity Capital Advisors, which is an SEC-registered investment advisory firm that currently manages over $3.4 billion of client assets. Dave was recently named to the Investment News 40 Under 40, which is a very prestigious award. That's a national award for all of wealth advisors across the country. He was also a Think Advisor Luminaries 2023 winner, an Investment News Award 2024 winner, and I won't keep going with those. Dave, I'm going to turn it over to you.
Conrad, thanks so much for the introduction and the setup for today's conversation. As you mentioned earlier, this is not political at this point, right? These are sunsetting provisions that are going to happen unless there's new tax law that comes to fruition this year or next year, which has a very low probability of happening. And so in 2017, we saw these sweeping tax cuts and they lowered almost everybody's tax rate. Now, the reason that this is so important is that at the end of next year, at the end of 2025, as Conrad mentioned, those provisions are sunsetting. And the reality of those provisions and pretty much any provision in the tax code boils down to these 7 simple words. Not all money is taxed the same. This is something that Conrad and I talk about with our clients all day, every day. Because if you can understand this simple concept that not all money is taxed the same, you could protect what's taken you a lifetime to accumulate. You could strategically navigate the tax code to help you reduce not only your taxes each and every year, but more importantly, your lifetime taxes, because taxes are the single largest expense that any of us are ever going to have. And there's a huge difference between tax planning and tax management. And you could even throw in tax preparation. But our firm, Alison Wealth Management, we really double down and focus on tax planning with our clients. We know some of the changes that are going to happen to the tax code. We know taxes are going to go up. We know when taxes are going to go up. And so we want to make sure that we have a plan in place for how our clients could navigate these tax changes. But something that we do a little bit different than most other firms out there, whether it's a CPA firm or a wealth management firm, is we engage in strategic tax management. This is the art and the science of continuing to build your wealth in a systematic way that reduces not only your tax burden each and every year, but your lifetime taxes. And what's interesting about taxes are they really never go away. We talk about 3 distinct phases to how we manage taxes. Of course, for our clients that are attending this webinar today that are still working and accumulating, we all know Uncle Sam takes a big chunk of your earnings each and every year. But when you retire, taxes stay with you in and through retirement. A big area we focus on with our clients is taxes in retirement and building tax efficient retirement income distribution streams. Because in retirement, if we could help reduce your taxes, that gives you more consumable discretionary spending ability throughout your lifetime. It also helps protect against longevity, the risk of running out of money. It helps you pass on more wealth to your family because you're minimizing the impact of what the government is getting. And last but not least, they always say that there's only 2 certainties in life, death and taxes. Well, how about taxes at death? The right to transfer your assets on to your family and to your beneficiaries. And so when we work with clients, we're not just doing what a lot of other tax firms do of looking at your tax return and trying to maximize your refund and minimize your taxes in the current year. We're looking at these 3 distinct phases of taxes. It's like a game of chess, not checkers. You need to be thinking 3, 4, 5 moves ahead. How is your life going to impact your tax situation? How is public policy and law going to impact your tax situation? And that's what we're here to talk about today. There's some key sunsetting provisions we feel everybody needs to be informed of because there's things you could be doing today that could help reduce taxation in the future. And again, reduced taxation in the future brings about more financial stability to your situation. The big 4 we're going to talk about in this short webinar today are the standard deduction and personal exemptions, the tax brackets, qualified business income deductions, and the estate and gift tax exemption. These are 4 things that are going to hit hard to many taxpayers, and you need to have a plan in place, and you need to have a team that's managing your wealth and managing your taxes to ultimately grow and protect what you have and mitigate future taxation. So let's jump right into the standard deduction because this was one of the biggest changes brought about by the Tax Cuts and Jobs Act in 2017. Maybe you remember how you filed your taxes, but you can see over in the upper right-hand side of my screen, we had a standard deduction of $6,350 for a single taxpayer or $12,700 for a married couple filing a joint tax return. This is the amount of money that you could have and not pay any income tax at all. It's a normal deduction that everybody gets. Now, some of you might itemize your deduction. Maybe you pay a lot of state tax. Maybe you have a mortgage that you're paying interest on. Maybe you have a lot of medical expenses or you do a lot of charitable giving. But if you don't itemize your deduction, the standard deduction is the amount of tax-free money you get. You can see in 2024, the standard deduction for a single filer is $14,600. For married, it's almost $30,000. That's a lot more income you could have without having to pay any income tax. That drove a lot of tax cuts to pretty much everyone out there. It also caused a lot more people to take the standard deduction instead of itemizing. Now, under the 2017 tax law, there was also a personal exemption of $4,050 for each filer. So single filer gets one personal exemption, married filing jointly gets two. The impact of this alone and just this sunsetting provision, because the standard deduction is one of the sunsetting provisions. We're going to sunset back to the old levels, which were much lower. And if you look at the brackets, we're going to talk about brackets changing in a little bit, but the brackets are going to sunset. Another tax cut that happened in 2017 is the brackets went down at almost every level. For example, the 15% went down to 12%, but those brackets are going to revert back to the old brackets. And so if you just look at the impact of lowering the standard deduction and you're taking the standard deduction, if you're in the 10% bracket, that's a $290 a year tax increase for a single filer over the age of 65. If you're in the 15% bracket, it's almost $500. All the way up to the 39% bracket, that's an about $1,100 tax increase. If you're married, you can see that in the lowest bracket, it equates out to a tax increase of about $1,000, and in the highest bracket, about $4,000. So this is meaningful money. It's meaningful, particularly if you're maybe a retiree living on a fixed income, because this is right out of your bottom line that we need to account for and have a plan for, because there's ways that you could potentially mitigate these future tax increases. In addition to that, the brackets are scheduled to change. So in 2024, we call this our tax measuring cup. If you're married, look at the right-hand side. If you're single, look at the left-hand side. I mentioned that standard deduction, $29,200 for a married couple, $14,600 for a single. From there, any additional income you have starts to flow into the measuring cup. After the standard deduction, the next $23,200 for a married couple or $11,600 for a single filer is taxed at a 10% marginal rate. So if you had $23,200 of taxable income above and beyond the standard deduction and you're married, you would owe an additional $2,320 of tax. But for every dollar of income that goes over that measuring cup line, you're taxed at a 12% marginal rate up to $94,300. For every dollar of income that goes over the line between the 12 and the 22%, you're taxed at a 22% marginal rate. So if you had $100,000 of taxable income above and beyond the standard deduction, you'd be about $5,700 into that 22% bracket as a married couple. That amount is assessed at a 22% marginal rate. And of course, the ladder climbs. The more income you have, the more taxes you pay, the higher the rate is on the next dollar. It's a progressive pay-as-you-go system. And Conrad, how many times do we see clients come in and we review their tax return and they miss opportunities? They miss opportunities in these lower brackets to do things like Roth conversions or accelerate income or realize capital gains and pay a very little tax rate. But then what happens if they miss those opportunities? It's use it or lose it. They miss that opportunity to fill up those lower brackets. And then 5, 10, 15 years down the road, when they need the money and they need to take it out, what do they get whacked with?
Taxes.
They get whacked with taxes and they pay at a higher marginal rate, when instead they could have slowly started to diffuse this deferred tax liability in things like retirement accounts, IRAs, 401ks. And if we look at the tax code and talk about these sunsetting provisions, again, if you're married, look at the left hand side. If you're single, look at the right hand side. We can see what the brackets were in 2017, what they are this year in 2024, and what they're scheduled to go back to in 2026. Of course, 2026 numbers will be indexed for inflation, but you can see the massive impact. It's not just a tax increase on the highest income earners, it's almost everyone across the board. It doesn't take a mathematician to realize that a 12% tax bracket is better than a 15%. A 22% is lower than a 25%. A 24% is lower than a 28%. A 32 is lower than a 33. But it's not just the bracket, it's the amount of income you could realize until you're in that higher bracket. So again, as a married filing jointly, you could have $200,000 of income today and be in the 22% bracket. But if you had $200,000 of income under the old tax regime, you were into the 28% bracket. That's a substantial increase in tax. So it's not just the brackets going up, it's the amount of income that's getting compressed. And this is what causes a tax increase on almost everyone. I say a rising tide. I'm a boater, I'm a big fisherman. A rising tide lifts all boats. It's going to create a tax increase on lower income individuals as well as our high income earning clients. And just like anything, the time you want to make a purchase is when things are on sale, right? It's why people act so crazy on Black Friday, trampling each other to get the big screen TV that's got $50 off. Well, taxes are on sale right now. The sale is expected to end at the end of next year, 2025. So there's some strategic considerations that you need to be thinking about and working with a team like ours on to navigate prior to 2026. Some of these big things that I know, Conrad, you're talking to clients every day on are accelerating income. Why would you want to accelerate income? Because you want to be taxed at the lower rates that exist today versus rates after 2026 that are scheduled to go up, or even worse, with the amount of debt Conrad showed earlier, taxes could be substantially higher in the future. You want to start diffusing these tax time bombs today while rates are low. There's Roth conversions. We have the ability to analyze your itemized deductions. Maybe we can bunch up a bunch of itemized deductions and give you a bigger tax break. Conrad, what are a couple of the things that stand out from an itemized deduction standpoint that people need to be thinking about in 2024 and 2025?
Absolutely. Yeah, I think the big ones, you've got them listed here, charitable giving strategies, right? Are we thinking about how to strategically position those for maximum impact? You mentioned at the onset a higher standard deduction. Well, if your charitable contributions don't have a big impact in any one year, but coupled together make a big impact at one time, we should think about how we bunch those contributions. The other thing that we've started looking at is state and local taxes, right? We've had a large change in the ability to write off state taxes, especially for business owners. And so those techniques, we won't get into that today because that's a whole, we'll call that a rabbit hole. It's probably bigger than that. But how to strategically avoid that state and local income tax limit of $10,000 for a married couple. The last thing is really miscellaneous itemized deductions. This is a big one that we see that most people miss. People in states like California or other states that are non-conforming states, meaning that they don't conform to certain rules at the federal level. This is one of those where miscellaneous itemized deductions like investment advisor fees or tax preparation fees, while they're no longer deductible at the federal level, they are still at the state level potentially. And so we see those missed deductions all the time.
Absolutely. And this is a big way we help our clients find money that they're losing unknowingly or unwillingly. And, this all adds up. And when we think about the structure of your money, we all have three tax efficient funnels that we could accumulate money in. And then when we go to retire, we have these three funnels to create our retirement income from. We have our pre tax funnel, which is where we're getting deductions today. We're deferring the tax to a future time period. But when we take the money out, it's going to be fully taxed at whatever tax rates are into the future. So you're making a gamble here. You're gambling that your tax rates are going to be lower in the future than they are today. Because why would you ever want to put money into these accounts and defer tax today at a low bracket when you know taxes are going to be higher in the future? These accounts are very valuable if you're making a lot of money and you're in a high tax bracket and you're going to potentially retire later on and be in a much lower bracket. But the opposite of this is our tax advantaged funnel. These are things like our Roth accounts, our health savings accounts, anything that we don't get a deduction to necessarily put the money into today. It still grows tax deferred, but when we take the money out later on in life, it's completely income tax free, both the contributions and all the investment gains. And so these are really favorable accounts if you think tax rates are going to be higher for yourself in the future. Now, the government limits how much we can pretty much put in pre-tax accounts, and they limit how much we can, for the most part, put into tax advantaged accounts, with the exception of cash value life insurance. There is, of course, no limit to how much money we could accumulate in post-tax status. These are like our brokerage accounts, our bank accounts, our real estate, our business interests. Typically, you're double taxed on this money. You're taxed when you earn the money, then you go save and invest it. And assuming it grows in value, you're taxed again when you realize the gain, but it's taxed at a more preferential rate. So there's really important decisions of how you should be accumulating money in these tax diversified funnels. How much you should have in each one of these is there is an optimal amount based on your individual situation. And then when you go to take withdrawals from your account, whether you need money for a large purchase, to start a business, to buy a new home, to go and retire, there's an optimal blend of how you should take money out of these accounts to maximize your income and minimize your taxes. Now, the third thing with the Tax Cuts and Jobs Act sunsetting is this qualified business income deduction. This is relevant for our business owners, whether you're running a big company or you have a side hustle, consulting income, board income. A big centerpiece of the law in 2017 was a cut in corporate tax rates for big C corporations from 35% to 21%. But most businesses are small businesses. They're pass-through entities like sole proprietorships, LLCs, S corporations, partnerships. And so it was unfair to cut the tax rate for C corps, but not cut the tax rate for these pass-through entities. Thus, the qualified business income deduction was enacted to ensure equity in the tax system. Now, this became a labyrinth of planning opportunities for small business owners. Conrad, I know this is an area you specialize in. And how
Right.
many times do you see business owners leaving money on the table or overpaying in taxes because they don't have a thorough plan for navigating this enormous qualified business income deduction? It could be a deduction of up to 20% of your income. Think about that. If you do this right, you only pay tax on 80% of your income. Well, guess what? This is scheduled to sunset at the end of next year. And so while there's amazing planning to be had this year and next year, there's also even more important planning to start thinking about for what happens after this deduction is eliminated. Many people changed their entity structure just to take advantage of this tax benefit. And we need to think about how to potentially unwind that. We want to think about how to potentially manage your business income, because if you're in a specified service industry, there's phase outs, which means if your income is too high, you actually don't qualify for this deduction at all. And there's some really great techniques to help you get within the phase outs. We can defer or accelerate accounts receivable. We could reduce or increase deferrals to retirement accounts. We could strategically time big purchases. Maybe we consider filing separately instead of married filing jointly. Maybe we change the business entity to a C corporation. We look at how you're paying employees and yourself and what your wages are. So, Conrad, like, this is complicated tax stuff. I mean, you've been a CPA for 20 years. Is this not one of the more complicated provisions you've seen in the tax code for small business owners?
Absolutely. I describe this, and no offense to anyone out there, especially what I'm going to say, my CPA brethren, but a lot of times, right, CPAs use tools as we're trying to hammer in a nail, right? And when you're a hammer, everything looks like a nail. And so I think a lot of times we miss planning opportunities. And you can just look at this list of opportunities that exist for most small business owners. But what we need to do is understand what are some of the goals that you have and how do we apply that to this logic. The QBI deduction, as it starts to phase out, will have a major impact on the small business community in America. And I think that's important to understand, not just from a small business owner perspective, but from a taxpayer perspective. We are going to see an increase in cost inequitably rateable to small business owners as this provision expires.
Now, Conrad, I want to jump into an area. I know I spend a lot of time working with our high net worth and ultra high net worth clients at Alison Wealth Management. And a big topic of discussion is, how do we keep the wealth in the family? How do we reduce lifetime taxes? How do we create multi generational wealth? And there's something known as the estate and gift exemption. This is a tax on the right to transfer or give your money to anyone you want, your family, your loved ones, your friends. And right now, under the tax code, the exemption in 2024 is $13.6 million per individual. This means that, Conrad, you're a great guy. I could give you $13.6 million and you or I don't pay a tax on the gift. But if I give you more than 13.6 million, I owe a gift tax. Or if I passed away, I could leave my family 13.6 million in my taxable estate. But if I left them any more than 13.6 million, the government will tax the excess above the exemption at a 40% tax rate. So let's say, for simple math, you had $20.61 million. That's $7 million over the exemption, and you were to pass away. That 7 million over the exemption would face a 40% tax, transferring it to your family. That's a $2.1 million tax. It's a big tax bill. Now, the interesting thing about the estate and gift tax is it's an optional tax. With the right type of planning, working with the right professionals, we could help you avoid this altogether. But what's interesting is this is a sunsetting provision. It's scheduled to revert back to the 2017 levels plus inflation. In 2017, it was 5.49 million. This means if you're a single individual and you pass away and you have more than $5.5 million, the government is going to tax any of the excess at a 40% rate. To many of you, that might seem unfair. You worked hard, you paid taxes your entire life. You want your kids, your family to get this money, but there's another beneficiary, and it's Uncle Sam, and there's a tax rate of 40% there. This is something that could hit hard to a lot of families because, quite honestly, there's not a lot of families that have over 13.6 million, or as a married couple, 27 million. But with where asset levels are now, with where property values are now, there are certainly a lot of individuals with over 5.5 million, or 11 million as a married couple. This not only includes your real estate, your business interests, it also includes the death benefit of any life insurance policies, whether it's a term policy or a group policy you have at work or you have private life insurance. It's all of your assets combined. So there's some strategies to eliminate this, as I mentioned. Number one, we would look at lifetime gifts. If you have enough money for yourself throughout your lifetime, you might want to start gifting some of this money to family members. Get it out of your taxable estate. The government allows us to gift up to $18,000 per participant per year to as many participants as we want. Married couples could double that. You might want to gift to minors. We set up things like uniform transfer to minor accounts. These are trust accounts, or we start setting up inheritance trusts for the next generation. We could start using that money to buy life insurance. Life insurance is the only asset class that we can structure to be both income tax free upon your passing, as well as estate tax free if we structure it the right way. Again, we mentioned establishing irrevocable trusts. This is money that maybe still is beneficial to you or your spouse for your retirement, but it's not countable in your taxable estate. It's a way that we can freeze your estate value through the use of family trusts, inheritance trusts, or spousal lifetime access trusts that still give you control and access to the money, but help eliminate taxes. And then last but not least is charitable giving. This could help reduce your taxable estate. It could create large tax deductions. We have charitable trusts. We have donor advised funds. We have outright giving. We have private foundations. There's all kinds of tips and techniques that if you've accumulated more money than you feel that you need in your lifetime, we've got great strategies to be able to deploy to minimize lifetime taxes. And Conrad, as I look in my side mirror on my car, it always says objects in the mirror are closer than they appear. And I feel that's absolutely the case with what's going on. The Tax Cuts and Jobs Act sunsetting provision is closer than it appears at the end of next year. That's why at Alison Wealth Management, we implement our tax management journey. We take our clients through our systematic proven process around maximizing your income and minimizing your taxes, helping you understand that there's an order to money, an order to how much you should accumulate and what types of funnels, and then in order to how you should start taking distributions. We want to measure your bracket each year to look for opportunities to accelerate income, to create deductions, to do Roth conversions. We want to make sure we avoid marginal tax traps like a Social Security tax. We want to allocate tax sensitive assets because at the end of the day, it's not about what you make on your investments. It's about what you keep net after taxes. Maybe we look at gifting strategies, both charitable giving as well as intra-family gifting. We want to run an analysis on whether it does make sense to rip the Band-Aid off and pay some tax now, or whether we want to continue to defer and pay that tax later. And then last but not least, for our clients, every single year throughout the year, we're managing your dynamic bracket. It's about tax management. It's about this understanding that not all money is taxed the same. And we're here to help you reduce your lifetime taxes. So Conrad, talk about the special offer for anyone who attended today's webinar.
Yeah, anybody that attended today, what we're going to offer is a 25-minute complimentary consultation. In that, we want to ultimately achieve three things. We want to get to know you better. We want you to learn about us and how we might work. And then ultimately, we want to get your questions answered, right? I'm sure after all of this, there's not enough time in a webinar to go over every little piece of legislation that's changing, but you may have specific questions related to your situation. While we might not be able to give you exact answers, we're at least going to try to guide you or provide as much value as we can in that 25-minute session.
Yeah. And Conrad, if you're like me, I just want the bottom line. What does this mean to me? What do I need to do? And that's what we deliver through our planning process. So if you want to take advantage of that 25-minute introductory call, go to AlisonWealth.com/Conrad. And Conrad, it'll take them to your page here. Tell them how they can book right on your calendar.
Yeah, you can see on the right side of that page, it's a big blue button that says book now. What you'll want to do is click on that button. And when you do that, you're going to pull up a my calendar, click on a date that works for you. When you get to that, there will be time slots that you can choose from. In that, once you click on a date and time, you'll have a confirmation page. We just ask that you maybe give us some information, just some generic topics that you want to cover more specifically. That'll help me make sure we're getting to that bottom line, as Dave mentioned.
And Conrad, for anyone who takes advantage of our complimentary strategy session, we'll also send you a book, The Bucket Plan. The Bucket Plan is our holistic wealth management process we take all of our clients through to build a plan around the integration of financial and retirement income planning, asset management, tax management, protection planning, and ultimately legacy planning. So thanks so much for joining us today, and we look forward to talking to you on our complimentary strategy session call.